Good evening, everyone. Welcome to our MQ Trader webinar tonight on Unearthing the Gems, Navigating SGX Stocks for Stability. I'm Casey from MQ Trader and the host for today's event. So before I start, can I have a quick mic check? Can you type 1 in the chat box if you can hear me clearly? Max, thank you. Max is our speaker today. So I believe, can I have more response from the audience first to make sure everyone can hear me clearly? And also that everyone is in it. Okay, fine. So let's start. Let me start with a brief introduction to MQ Trader. Hold on. You can't chat, is it? Can everyone try again? That's why it's important for me to do a mic check and a chat box check. Yeah, there are more one coming in. Thank you for your response. Great. Okay. So let me start with a brief introduction of MQ Trader first. I believe most of you know us already, but for those who do not know us yet, MQ Trader stands for Malaysia Quantitative Trader Group. We collect quantitative data, means big data, and we do a lot of analysis using the data. This data and this type of analysis is normally only available to large financial institutions. So we have used it and we have developed a stock analysis tool with it. So we have made it available for free for all our MQ Trader members. We seek to empower them with quicker decisions and with greater confidence. So if you are interested to join or use the tool, remember to join us for MQ Trader. Now, how to join is you just need to open a trading account with our selected advertiser. We also have a lot of other programs in the MQ Trader system. But basically, when you open a trading account with our selected advertiser, these are the benefits shown on the screen that you can get from us as well. So you have free access to all MQ Trader system. You just need to open a trading account with M Equities LYH team or TA Securities Jessie Xiao team. All the QR code or links are shown on the screen. If you're interested, you can scan the QR code or visit the link to sign up or send us your interest. So other than the MQ Trader stock analysis tool system, we also have the MQ E-Trade system where you can view a lot of information of each stock counter at a glance. So all information including up to 10 market depths and also MQ trading signals, which is exclusive to our trading system. These are information that can facilitate your journey in your trading. We also have so this is how the stock analysis tool system looks like. We have the trading signals. We can see the green buy and sell signals generated from just one click. You can even backtest the signals as well. So if you're interested or if you are a current MQ Trader member, you remember to visit the link to use our tool. So again, if you're interested in all this information or all this system for free, you can just sign up for a trading account with the respective team on the screen. And for today only, for those who sign up for a trading account with our selected advertiser, you can get a bonus 500 MQ points as well. So if you're interested, remember to sign up now or send the contact details to the respective team. For our current MQ Trader members, you can also get a bonus of 300 MQ points as a check-in rewards. You just need to screenshot on any part of the webinar and then submit it to the quiz that will be sent to your email after the webinar ends. So remember, screenshot and then submit it in the quiz itself. But of course, remember the prerequisite is you need to open a trading account with our selected advertiser and also have a MQ Trader account linked. With this, I will give you a few seconds to take a screenshot now in case you've forgotten. Okay, for those who have not registered for the webinar yet, but you can register now because if you want to get our post-webinar updates, you need to register. So we'll be sending all the quiz and even the recordings to all who register. So if you are interested to getting all our post-webinar updates, remember to register. You can register using the QR code or the link shown on the screen. Right, we will have a Q&A session after our sharing, our speakers sharing. So feel free to send us your inquiries throughout the sharing session, and we will pick some of them or filter it in case we have not enough time. So we'll try to answer it by the end of the sharing. And after the Q&A session, we will be giving out gifts worth up to 249 ringgit in our mysterious gift session. So do stay tuned for it as well. After the Q&A, there will be a mysterious gift session. And about our speaker today, he is Max Tan. He is an SGX Academy speaker with over 7 years of experience investing in the stock market. He also has various experience on sharing on various platforms regarding the topic on finance. And Max today will be sharing with us in-depth analysis on stocks that offer steady returns in the Singapore stock market. And he'll also be sharing how to discover undervalued equities that offer stability and also provide some insights to assist investors to navigate through the market as well. So are you guys ready for him to share? Can you type ready in the chat box to let me know you're ready? Nicole, thank you for being the first one to answer. Right, so I believe all of you are ready now. Thank you for your response. So without further ado, let me pass the time to Max.
Right, thank you so much. Let me share my screen for a bit. All right. Can you guys see my screen? If you can you type in a yes, so that I know I can kickstart the session? Okay, thank you so much, everyone. Once again, thank you, host, for the kind introduction. And thank you, everyone, for joining us today on the session by the topic, Unearthing Gems, Navigating SGX Stocks for Stability. Today's session, we will be briefly talking about what happened in the stock market recently and why is it important to actually look at the SGX stock market as a whole, especially in such uncertain times, right? So again, a brief introduction about myself. My name is Max. I'm from Want to Invest, a blog specialized in finance and investment related contents in Mandarin. And for those who are active on iTrade Investor, perhaps you have seen us on some of the contents we created on Eventure Group. So I'm currently also a speaker of SGX Academy speaker. So hopefully today's session will be helpful for everyone here. But before I really begin, I would like to make a very quick disclaimer where all the contents, all the information that we have shared today are purely for educational purposes only and should not be treated by any means any form of a buy, sell, hold recommendation. Now, if you really need this kind of investment advice, so please consult a licensed, investment analyst or financial advisor for it. Okay. So with that in place, I think we can now officially start our sharing session today, right? So I think we are in a, to say the least, we are in such a uncertain time now, where I think in the world of investment, we can see a lot of uncertainties coming, whether it's from the few aspects, the political aspects, market aspects, currency aspects. If you are Malaysian, then I'm sure that you have seen ringgit experience quite a swing, and also some trend aspects that we share on, for example, like a industry, what's an industry or sub-segment that investors could look at. And hopefully I think we have the time for one case study, but again, the case study is purely for educational purposes only, should not be served by any means as investment advice. So let's get into it on some of the trends that, or big things that happened in the market recently. So if you have read the news, I think today or maybe yesterday, Fitch Ratings have actually warned that the largest economy in the world, effectively US, their banking industry may face another round of turmoil. Basically, that means that some of the US banks, they may face another round of downgrading, the risk of being downgrading another rounds. And I believe that would send chills to the spines of many investors, especially for the institutional investors that are targeting the US market. So just for information, Fitch first downgraded the operating environment of US banking industry to AA minus. Now, if it's downgraded to once again to A plus, then it's safe to say we can expect more volatility or downwards pressure on the overall market to come. So basically, the concept is like is that US is considered the largest. It's not considered, generally speaking, in terms of GDP, they are the largest. So imagine that the largest economy, their banks are being downgraded in terms of their bond ratings. So we can imagine that the trustworthiness of them repaying the bond has been downgraded. So what does that mean to investors? Basically means that the economy is not going to do well. And in that sense itself, so it would spook a lot of investors. A lot of funds will be withdrawn from not only the bond market, it would, if affect the capital market as well, the equity market as well. So it's quite a serious issue, right? So another thing that I think a lot of investors should take note of is the interest rate. Now, the next FOMC meeting is expected to come in 19 or 20 September 2023. And if you take a step back and look at the previous developments by the Fed action back in July 2023, the Fed, they raised the target range for federal funds rate to 25 basis point. Basically, it's 5.25 to 5.5. So if you are in Malaysia, then you would know that the interest rate is actually quite high. Actually, in fact, this is the highest borrowing cost since 2001, the range of 5.25 and 5.5. However, judging from the stock market performance, this is actually in line with what the market actually expects. And the headline inflation has actually slowed down to 3% back in June. So what's more interesting is with all this interest rate high is not low, 5.something%. Just a few days ago, we've seen an interesting news where Berkshire Hathaway, Warren Buffett's company, just in case you're new to the market, had invested in the three major US home builder stocks, D.R. Horton, Lennar, and VR. So it's interesting to think that now you see interest rate has always been one of the major factors that affect home sales, because as a home buyer, if the interest rate is high, then you would think twice before you get into a loan and then you go and purchase a house. Of course, if you buy the house with cash, then I have nothing to say. That's a different level ball game. But most of us, common people like us, we would take on a loan just to buy a house. So borrowing costs higher, we would think twice, and then the cautious stance of a consumer would affect the sales of a lot of home builders. But interesting now, Berkshire Hathaway is actually investing back into the home builders now. It is obviously showing a sign of confidence back into the property market in US. So what does that mean is that aside there's a positive sign by Warren Buffett into the property market, it could only also hint that there could be a slowdown or maybe a stop in interest rate hike. So hopefully there will be a reversion back, a downwards reversion of the interest rate in US market in 2024. We do not know yet. But generally speaking, I'm sure most of you know that interest rate drops, it's actually positive to the equity market. So hopefully that happens. But with that being said, if you look at the US market, NASDAQ, US 30, they actually have been performing quite well as compared to the market as a whole. So as at today, the return for NASDAQ and US 30 on year-to-date basis is actually 36.5% and 5.5%. So if you think of it, it's quite crazy, even how uncertain the whole market is on the US side of things. So we'll talk a bit about the risks on investing into US later on. Now, that's on the US. On China, however, the market previously, we're talking about 2023 earlier, has always been anticipating the recovery of China. It will bring a recovery to the demand on a global scale. It doesn't matter on what are the items, whether it's semiconductor, whether it's consumer products, whether it's the commodities. There has been a hope of recovery of demand a bit back in earlier 2023. Now, personally, I have not been to China, but after some of the conversations with the top management of some of the companies, they have exposure to the China market. It seems that the recovery in China has not been so positive yet. And now, if you look at some of the companies' financial report recently, definitely you will see there are some red lights or some of the negative views that saying the China market have not recovered. It has not been so positive, not as good as what people expect. Now, if you have a look at the news recently, there are also some red lights in the housing market as opposed to what happening in US. There are substantial investment back into property market. Two companies specifically, they have kind of shocked the market. One is Country Gardens. The share price is actually in historical low. The company has suspended at least 10 onshore bonds. And then another company, Sino Ocean, also suspended trading of their 6% guarantee notes of due 2024 because of failure to pay a $20 million value in interest. So I'm sure with everyone here, this is not the first time that we have seen a, failure of paying interest or principal by the China market. So with that in mind, obviously there are a lot of instability in the market. HSI year to date is a negative 9.6 performance. But how about Malaysia itself? Now in Malaysia itself, the recent state election is expected to bring stability into our stock market, especially on the currency itself. Now PH being able to retain some of the key states reduce some of the economic political uncertainty, and some of the analysts view it as a positive sign by investors of the country. And also the result end in a 3-3 stalemate, which I'm sure everyone has already know, having a neutral impact on the Bursa Malaysia and also the ringgit. Yet, we're talking about index as a whole. If you look at the index of Bursa Malaysia, Bursa Malaysia has been lacking, FBM KLCI has been lacking fresh blood, which means fresh constituent into it, and also lacking fresh foreign fund flow back into the market. FBM KLCI, needless to say, represented a negative 1.7% performance, even after the post-election performance. Now, normally I would like to look at smaller companies because usually they represent a more holistic market view. FBM small cap, things are actually even better compared to FBM KLCI, a plus 5.7 performance on year-to-date basis. Okay. Now, all these markets, they actually have their pros and cons, but if you're seeking primarily on the stability kind of things, perhaps if you consider all the things in mind, political and also the currency, most importantly to me is actually the currency and also the international stance of Singapore. Actually, is one of the interesting one for our discussion today, which is essentially the most important thing. The most crucial factor that we need to understand before investing into the Singapore market. So perks of investing into Singapore market, of course, you have access to international stocks. There's a stability, and you have the capability of able to diversify your portfolio. Now, please allow me to share this. One moment. Okay. So this is actually the 5 currencies as compared to Singapore. You can see there is primarily is actually on the Sing to JPY, Sing to Ringgit, Sing to US dollar, Sing to China Yuan, and Sing to Australia dollar. Basically, apart from US dollar, Singapore dollar has fared pretty well. This is because obviously the US dollar, their interest rate is very high. So on a year-to-date basis, it's actually performing quite well, quite strongly. And on a 1-year basis, I think it's all positive in that sense. I think there's some issue with the chart, but you get the idea. Basically, Sing dollar is really strong performance recently. Okay, so a bit more about the SGX market as a whole, in case you are new to it. Singapore Exchange always has the reputation of being a symbol of stability amongst the capital market, especially in Asian region. One, political, second, economy also relatively stable, especially that can be represented on their currency. Quite stable so far. If you monitor from 2020 to 2023, it's still relatively stable. Okay. Some of the important data, especially for the month of June up to 2023, you can note that the FX volume, specifically happening in the Singapore market, rising above 100 billion US dollar for the first time ever. So that shows that how deep it is in the Singapore market. So first half 2023, Singapore rates purchased by retail investors had around 390 million Sing dollar. By the way, for your Q&A later, sake of Q&A later, you will have a question probably on the gearing ratio. So it's similar to Malaysia, which is 50%, just for information. And then commodities wise, commodities volume also increased by 1/3 the trader volume for the first half of 2023. So basically saying, even you see that all the not being stable, all these ups and downs in the market, Singapore market, they still saw a growth across multiple asset classes, FX, REITs, and also equities and commodities as well. And then we're talking about derivatives. Trader volume increased by 4% on month by the month of June. And then, interestingly, if you are into China market, but you do not know how to get exposure, Singapore, they actually have a SGX FTSE China A50 Index futures. I think that's based on the statistics, is still the most liquid one. If in case you want to get direct access to into the China market itself. But bear in mind, today's session will be on equity, so that it's a future contract that will be in another topic that will require another specialist on the futures. So this is just for information. You can get exposure to international equities or indexes through the Singapore market. Now, the daily traded volume for securities specifically also increased by 14% on one-on-one basis, where the total asset management under management for ETF increased by 3%. So all this data, if you don't remember them, don't worry about it. It's not really that critical. And if you go to the SGX website, you can have the access of all these kind of data as you can see over here. But this is just for information on what's going on the Singapore market and also how on the liquidity. Because as investors, obviously we want to look for a stable and liquid market to invest our money in. So these are just some of the statistics to share with you. Okay, and we also shared just now how the Sing dollar performed against a couple of currencies. So again, if you are investing purely on ringgit basis, I think you are like me. Over 70% of my assets are actually in ringgit, but I am seeking to diversify into Sing dollar is my priority for now. So obvious reason, as you can see the chart there, is performing really, really well for your asset preservation. So imagine this, even that your return in Malaysia, let's say you buy a REIT in Malaysia, the return is 6%, and you buy a REIT in Singapore, the return is 6% as well. But because of the currency advantage you have over in Singapore market, which is year to date is around 4% additional. So you can see there's an edge of overall return on your portfolio compared, just invest in a neighboring country. That's the edge of the currency we are seeing here. But of course, there are some companies that you can only invest in Malaysia. Some companies you can only able to find them in the Singapore market, some in the US. So it ultimately depends on what kind of companies you are looking at, right? And speaking of currency, just a little bit of additional kind of discussion. We understand that the market is going on a trend of de-dollarization. So basically saying that a lot of countries, they are trying to move away from US dollar itself, especially if you look at some of the key oil producing country, they're actually opting in for China yuan. So honestly, we do not know who would ultimately win the race, but it seems like China yuan, they are really getting a really, really good traction in this case. Based on for your information, estimation on April this year by Bloomberg, US dollar actually stands for 88% of all international trades. So we can revisit the statistics by next year. Let's see how whether the market actually start shifting towards other currency as well. But I would still rather place my own money in a more stable currency, as we know there's a lot of geopolitical tension between those. JPY actually lost its edge over Sing dollar. Just now you see the chart over there. The best performer Sing dollar going against is actually JPY. So people are shifting away from JPY to Sing dollar. So simply having the assets on Sing dollar base would give you a very good, I would say, global risk hedging on your performance itself, right? Okay, so that is on the overall holistic kind of view. Why should we actually look into the Singapore market? Now, what is actually gems? Okay, in our topic, what is actually gems? If you look at the top right corner, sorry, no shortcut. Whatever market you are investing in, as long as you are investing in equity, there are no shortcut. But I want to clarify a bit on what is ultimately gems. I think gems, it's quite subjective, depends on the investor itself. There is still one important factor, which is the expectation, your expectation. So if you are expecting in such market, in this kind of market, it's not a bull market, obviously. We are probably in a slight bear market. So if you are expecting the gem to be a 10 bagger, 20 bagger within a year. So those are not gems. More than likely, those are getting a lottery or gamble itself, and normally they will be penny stock that give you such a return. So unfortunately, we are not able to identify this kind of stocks, but more towards to look for really good stable companies that are able to give you a consistent return, to able to preserve your capital over the long term and having growth ultimately, right? So today's topic was emphasizing on the word stable. So if you are looking for stable, then probably whatever we share in upcoming, that will be important for you to actually identify the companies in Singapore Exchange, right? So when we talk about sector, probably pharmaceutical technology stocks, they are not really relatively that stable, okay, unless you really understand their business model. So when we talk about stable in terms of business model wise, then probably the banking industry is doing really, really well in terms of the Singapore market. If you look at the share price performance, relatively really stable. Okay, if you look at DBS, all those big banks, and also REITs so far, the yield in Singapore is very attractive. And also to add on, depending on the currency that your assets are based in, if you invest in Sing dollar, basically you will get an additional return on top of that. Then another thing is that quite a number of foreign FMCG companies, they also get listed into the Singapore market as well. But before that, let us talk a bit about the business model of a company, which is the most important aspect, in my personal opinion, to identifying gems specifically. Okay, when we are actually deciding if a company would deliver good results, these are the factors, by the way. If you are trying to decide whether a company is a gem, right? So what kind of metrics do you look for? Obvious answer would be share price, but what lies before the share price? What would cause the share price to move? Demand and supply, but the financial results of the company, the fundamental of the company would, over the long run, would drive the share price itself, right? But if you think of it, looking at financial results, they actually come in, let's say quarterly report, 2 months delay from the date of quarterly report, quarterly closing, let's say April, May, and June. So naturally, you get a financial report, quarterly report by August. By then, a lot of things could happen in between. The share price may have already reflected, or by the time the share price, the financial result is out, you already missed the opportunity to invest in it. So fundamentally, how do you have a one-step advantage against the market? That is by understanding the business model of the company itself. But obviously, that will never be easy. Take, for example, the banking industry. I think, again, if you're investing into the Singapore market, I think the first or second industry you should look at is always the banking industry. And the next one could be REITs. Those are the more stable industry in the Singapore market and the more attractive one. The banking industry, you need to find out what is their business model. Obviously, this is banking, right? And the revenue generated by the banks could be separated into two types. The first one being fee-based income, and the second one being fund-based income. So as the name suggests, the first type of income is typically by the services provided by the banks, meaning that they charge a fee to consumer like you and me, whether it's account maintenance, your ATM fees, your credit card service fees, investment banking services, asset management, brokerage. Okay, those are the examples of fee-based income. There are the banks that they are very strong on fee-based. There are also the banks that they are very strong on fund-based income. So what does fund-based income mean? So funds, as the name suggests, it means that the bank, they will lend out money and they will earn interest on loans, mortgage, or other types of credit proceeds that typically exceeds their cost of borrowing. For example, if you put in 1,000 ringgit on the bank, and the bank lends out the money, that is the interest difference between the two is what we call net interest margin. That is the fund-based margin for the bank between your deposits and also the money that they lend out, right? And obviously, the interest margin is, or the fund-based income is a critical source of income for many, many banks. Not all the banks, they actually focus on the fee base. Some of them, they focus on the fund-based income instead. Okay. Now, once you understand how a bank make the money, obviously this is a simplified version, but you have a general idea on how they make money. Then we can think deeper into some of the factors that could, impact the financial performance of the bank. Again, we are trying to be a bit of a predictive here, trying to predict how the bank would perform for the upcoming quarters, so you can invest at this moment and then you can take profit in the future, hopefully, right? Then you need to think what are the factors that could affect two things: the fee-based and also the fund-based income of the bank itself. So I think the obvious answers would be, first one, the broad economy performance of the country the bank has involved in. So let's say a Singapore bank, they have exposure in Singapore. Perhaps they also have exposure to Indonesia market, the Vietnam market, and maybe Malaysia market. So understand how these countries, they are actually performing in a broad-based basis. Because banks, if you notice, their performance usually mirror the overall economy. So if you have a deeper understanding on the economies of the countries they operate in, that would be really, really great. Then next up, for banks itself, understand the branding impact or competitive position. For example, like some of the banks, they have a lower NPL because they are more prudent, their management are more prudent. They don't give out loan that easily based on credit scoring. So some of the banks, they have a lower, cost to income ratio. That means that for every 1 ringgit they bring in, the costs are lower because they give, it's not that good for the employee, but perhaps they compensate their employee lesser, or they are less fancy, or they are more digitalized, so save a lot of costs by now. Or some of the banks, they have a higher net interest margin, which is a margin spread we mentioned before, but at what cost, right? If you have a higher NIM, probably you would have a higher non-performance loan, because the more loans you bring out, especially on you're charging higher interest, so your risk of getting an NPL normally would be higher as well. So these are the factors that could, affect your decision in investing in some of the banks and determining the quality aspect of the investment. And some the changes in terms of consumer behavior, it will also impact the performance of the banks as a whole. So I think there's a biggest mystery or biggest question in investors' mind is that rising interest rate. We mentioned about US, probably with all these symptoms here, there could be a stop of interest rate rising by the end of the year. Then hopefully by next year, interest rate starts dropping. So rising interest rate environment or diminishing interest rate environment, is it good for the bank or is it bad for the bank? So ultimately, the ultimate answer is that it depends on the deposits that the bank have, whether it's a fixed deposit or it's a normal saving account where it can withdraw anytime, and also the loan portfolio of the bank. Loan portfolio basically is the fixed portion. That means that it's like a higher purchase. The interest is fixed regardless of how the interest rate moves. And then you have the flexi portion, which the interest rate of your loan would move accordance to the interest rate of the whole market, right? Generally speaking, when interest rate high, if you look at it, it will impact the short-term performance of some of the banks. But as time progresses, they will slowly introduce more flexible rate products to the market, assuming in a rising interest rate environment. And eventually, the bank itself will be benefited by it over the longer term. By shorter term, I mean 1 or 2 quarters. Then subsequently, on longer basis, 3rd, 3rd or 4th quarter, they will get a better performance by then, right? So I think for REIT kind of business, everyone understands that REIT is for the benefit of those who are new to the market, which is real estate investment trust. That means that you are appointing someone to manage the assets you have. Assets in this context is basically properties, whether it's offices, whether it would be the industrial properties like a warehouse, like a manufacturing hub, etc. And some of the REITs, they have a data center. I'm sure it's quite famous. DC Capital is quite famous in Malaysia. And some of them, they have a logistic hub, which is quite famous here. And some of them has the hospitality assets, hotel, for example. So in this kind of environment, right, when we are likely to see a stop in terms of interest rate high. By the way, rise of interest rate, it will directly negatively impact the financial performance of the REITs in proportion to their debt, right? They have gearing because I don't think there's any REIT that they have no debts. They have a net, they own the asset completely. They do not owe any money to the bank at all. I don't think there's any kind of REIT so far. Normally, they would gear up to the optimal level, 40-ish% in order to maximize their return on the properties. So in that context, if you have a higher your loan, the higher interest rate will impact your financial performance. So if you're looking at REIT, probably next year we will see a stop in terms of how interest rate would eat up their profits, right? And then that is for the two easiest sector that investors should look at in the Singapore market as a whole, and also how do you look at their business model. Perhaps if we talk about the asset base for the REITs, right? If you are sensitive to the market, so let's take an example. Logistic assets, they are very much welcome no matter which country you are in now, right? People are, a lot of companies, they are actually moving their value chain across. They are trying to diversify their risks because of post-COVID era. So a lot of warehouse is currently in demand. Okay. Then another interesting sector in terms of valuation, which I will talk in a bit now, is the semiconductor industry in SGX. A lot of people actually overlook the semiconductor industry in Singapore market. So when we are investing into the technology or semiconductor industry, obviously you need a basic understanding of the business model of the semiconductor company. So for example, is the company that you are looking at, is it they're in the front end? Front end basically, it means that they are in the wafer, right? They haven't packaged it. That means that they haven't covered up to protect the wafer. They make it into a chip, which is the back end. So need to understand whether it's in the front end or back end. So no matter whether the company is in the front end or back end now, in terms of machinery, if they are in a capex or capital expenditure environment, most likely their product or services are seeing a slowdown because their customers are more cautious now. It's across the board. But you can dive in deeper so you can understand whether they are unique themselves or they're just a reseller for some of the semiconductor products, right? So if they're unique or they have a niche market, their customers would still need them regardless of the market. So take for example, this is not in Singapore market, but just for an idea, SML. SML, their products would still be required regardless the ups and downs because the demand is simply too much, right? And if they are just reseller, so basically they have not too much of a competitive advantage, then probably they will fall when the semiconductor cycle slow down, right? And if you dive even not maybe a slight deeper, then you can go into what kind of semiconductor sub-segment they are in. For example, if we are talking about the semiconductor industry now, the EV or AI industry is likely to enjoy better demands than consumer electronics. So consumer electronics back in 2020 or 2021, I'm sure that most of us here maybe have already purchased something, right? There's a spike in demand due to work from home trend, and then consumers by then they have nowhere to spend their money because you cannot go travel. So things that you can buy online is probably electronics or maybe furniture. Furniture at the time is doing very, very well. But there's a major trend back then. And then typical consumer electronics product cycle is around 3 years. So if you calculate, yes, another wave is coming for consumer electronics, but probably in 2024 or 2025. Or 2023 itself, if the company you're looking into is in the consumer electronics, probably financial performance for them is relatively slower, right? And then just for information, we mentioned why the semiconductor industry in Singapore market is so interesting. Back in June, statistics in June 2023, Bursa Malaysia Technology Index, we have a forward PE of 24 times. And if you look at the Singapore market, the technology sector TTM valuation PE is around 16.4. So there's quite a big gap. Malaysia forward is still 24. Forward, it means that we are looking for 1 year, probably into 2024. And the technology sector currently for Singapore is 16.4. It's actually quite close to their 3 years average PE of 16.6. So definitely there are quite a number of interesting technology companies in Singapore for you to actually go and look at them. So some examples, AEM. AEM is the test and handling equipment company. If by looking at Yahoo Finance just now, their PE is around 9 times. It's single digit, quite ridiculous if you have this kind of company with this kind of valuation. They're doing quite well financially as well. This kind of valuation, I don't think you can find across Malaysia or US or maybe even in the Hong Kong market. Single digit PE technology company. Then there's also Venture, there's also UMS, Nanofilm. Those are the companies that are very well welcomed back in the days. But so it's quite interesting to see that there's such a huge divergence in terms of valuation just across the board, right? Just looking in the neighboring country, you can immediately see there's a huge PE gap. Normally, generally speaking, AT automated test equipment players in Malaysia, we are talking about 20-something times PE for normal companies. And if you look at the size of AEM, later on we will have a glimpse of how AEM is performing. It's also our case study later. They're actually performing quite well, right? So generally speaking, we talk about the Singapore market as a whole. They're trading at 12.9 times PE overall. It's really low according to Simply Wall Street statistics. It's below its 3 years average PE of 25.1. So you can see that the market as a whole actually haven't rebounded yet for Singapore side of things, right? That I think we mentioned on the expected return business model and also the valuation of things, right? And financial wise, what should we look for in company? So naturally, when you open up the financial statement of a company, revenue, cost, and profit, right? Whatever you are looking into, growth is still the most important factor. We are talking about growth and not just maintaining the revenue. If factoring in the inflation, right? If a company is growing less than 3% per annum, more likely than not, the company is actually underperforming the whole market, right? Imagine the company is growing by 3%, and imagine if they only put their money in FD, that alone already probably earn them more than 3% per year, right? Putting in their money in FD itself. So for a company to have, only 3% growth per annum or less than that, I think that it's considered they are in the sunset industry, or the company generally something is wrong. Unless they're in the cyclical market, then it's a different story. So for example, the palm oil, they might not perform well now, but when the cycle comes, they would spike, right? But that one is on another topic. I want to emphasize that when you look into some of the companies in Singapore, whatever it is, 2022 is still considered high base. So if you study the financial reports of the Singapore companies, you should note that 2022 is a high base. And if you see there's a drop in terms of revenue, so I think it's quite normal, but it depends on what is the quantum of the revenue drops, right? If the company is able to show growth, then I will salute the company because it's doing very, very well. They are even performing better after the COVID pent-up demand, right? I will salute to them. They performing better than 2022 itself. But for companies across the board, I would say if the company itself, they are having a, let's say around flat to 5% growth in 2023, I would say that's very, very good. This kind of companies, you should really study deeper on their business model on, why is there still a growth after post-COVID era, right? Especially when the whole market is slowing down, that they are still able to perform better. But I think it's acceptable to see companies to have a retrace in revenue, probably in the range of 10 to 15%. So these are the companies that a lot of people, they would consider, oh, this company is actually doing not well financially. But if you were to dive deeper, you understand that this is a normalized financial performance. This is likely to be a normalized financial performance, and then it will grow on 2024, 2025 when the market returns, right? 10 to 15%, that's the quantum. Or if it's 0 to 5% growth, then I think it's very good, but subjective to the business model. Then for profit margin, we always talk about profit in terms of doing a business, right? There's no point that you have a mega revenue base, but you do not make any profit. So profit margin for me is exceptionally important, right? If you look at the performance of the companies, if the company is able to maintain the same margin as 2022 or 2021, then it's doing very well, super good, right? It's doing super good. But I think typically you don't expect any margin expansion by this year or the year to come. I don't think they could increase the margin, basically due to the demand or the instability across the board, right? But generally speaking, if you're looking for sort of companies, look for companies with 15% or more net profit margin, unless they are really cheap or they are in a unique business model. Like the industry itself, the profit margin is low at itself. Normally, I would choose for a company with 15% or more net profit margin and beyond. That means that the company is doing something special, that they deserve a relatively attractive margin. But I still want to highlight, ultimately, the purpose of any business is still making a cash flow, right? I think the cash flow is the most critical metric that investors should go and view. So whatever market you're in, to be honest, accounting numbers, revenue, profit, or cost, whatever, they can be created through creative accounting, right? Whatever the market you're in. But it's very hard, very tough to create a cash flow for a company. So normally they couldn't lie about cash flow. So the ultimate goal for business is still, remember, create excessive cash flow to reward the shareholders, whether in the form of share buyback, capital expenditure for growth, and then they pay out through dividend. So always look out for cash flow, right? And that's on the operating cash flow kind of things, right? With free cash flow. So do note that always this is linking back to the next financial ratio. If a company, they do not have good operating cash flow, they will ultimately resort to borrowing more funds. That would increase your gearing ratio, your debt to equity, and we talk a bit about ROE. ROE is a bit interesting, right? When they borrow more funds, that means that their interest expenses are higher and it will lower their net profit. Obviously, they also have a tight cash flow because they need to pay back the minimum commitment or principal, and they have to pay a higher interest. Or if they do not resort to borrowing, they will need to dilute their equity to raise more fresh funds, right? Which would impact the shareholders' interest overall. Okay, on that sense. Now, a lot of people, they would like to use ROE to benchmark whether the company is doing well based on the net assets they have. But bear in mind, where does ROE come from? So return, we know where the RR is basically the profit of the company. But in terms of the E, equity, again, asset minus debt equal to equity. The higher your asset, the higher your equity, right? But it's also the same when we talk about RE, right? The lower your E, the higher your RE, because it's the divide function. Let's say it's 10 divided by 5, you get a 2. But you get a 10 divided by, let's say, a 2, then your RE is 5. So naturally looking, the RE number is higher. But to lower down the what we call the E, they can have a higher debt. So it looks like the company is operating in a more effective environment. So always look at the balance sheet of the company, whether the equity portion making sense or not. Whether it's the ROE's company is so good, is because they have a lot of debt, right? Because the earnings of the company divided by the equity they have, obviously the ROE, the higher it is, the more effective the company is. But bear in mind, equity, it could be impacted easily by having higher debts, right? So be really careful on the financial ratio part of things, especially on the ROE usage. Do not just judge the company by looking at the ROE itself. And then we have a bit more time. Let me share on the screen. Okay. So one of the things that I actually like about SGX company is that they have a lot of what we call investor presentation. So it shows you a more holistic view actually on the Singapore market itself. So for example, I think this is their AGM slide. So it basically tell you what the company is doing, what kind of exposure they are having, right? Sorry, this is their first half 2023 results briefing slides. So it basically tell you how they perform, what kind of profit they have, what kind of revenue they have, and also whether the updated guidance. Some of the markets like US and also Singapore market, some of the companies they do provide a guidance. That means that the management might guide you through like how they would perform for this financial year, right? But some of the companies in Malaysia, unfortunately, I think most companies do not guide the financial performance for the financial year, right? There's no hard rules for the company to guide. So for the company itself, it's easier for me. If I don't guide, there's no chance for me to mislead investors or to miss the guidance, right? So there's a lesser risk for them to not expose their guidance. Okay, and you can see actually a lot of metrics here. Of course, if you can sit into the investor presentation, that would be best, but I don't think the companies they would open to retail investors to join in. But I think the information here, a lot of things they are interesting enough to for us to digest, right? I think this is the AGM 2023 slides. So they will show you some of the market updates, what are their target markets, and also right how the industry flow looks like, right? If you want to access this kind of data, I think it's relatively simple. Let's take an example of one moment, guys. Okay, so let's say you learn to look at DBS. Right, I think they have a lot of presentation minutes. Okay, they will basically show you how they perform and all this data, the NIM, whatever it is, you can always view it here, right? For some of the companies, you might not be able to access the financial performance or the in-depth data, but for most of the companies, I think in larger cap sense, you can actually access them in the Singapore market, right? So they also provide you the outlook, how would it perform and everything, right? So you just look at the company that you want to look at. You just type in the company you want to look at, let's say DBS, followed by a presentation. Normally they will lead you to the website that you can look at. This is also one of the perks of investing into the Singapore market actually. Unfortunately for Malaysia market, there is only a handful of company they would share their so-called presentation slide to the public. So I think this would be some of the perks of investing into the Singapore market. So maybe with that a little bit of time, we can take in one or two questions before we pass back to the host. Okay. Okay, let me look at the chat box and also the questions Q&A session. Guys, if possible, you guys could put in your question in the Q&A session because there are quite a lot of chat coming in actually. Okay,
Yeah.
so actually we have Victor. Sorry, yeah.
Yeah. Do you want to? Okay, you want to start Q&A now?
Yes. Do you need me to pass back to you first?
I will just share my screen while you are having the Q&A lah. It's okay.
Right. Okay.
Yeah. Do you want to start first?
Okay, let me go through the chat box and go one moment. Right. I think there's an interesting question there by Rosie. Sorry if I misread your name. How do we spot good discounted stock during economy downturn and to avoid catching the knife? So I think this is where the phrase of what is it called? This year. Okay. We invest the same amount of money. I forget the term again, full name of it, but it's called this year dollar cost averaging. So this is where this year coming in. If you want to build a consistent portfolio, avoid catching the knife. So number one, you have to understand the business very, very well. That you know that this company is actually temporarily affected by economy downturn, right? It is not the fundamental reasons or it's the internal factors that affect a company over the long term, which means that there are some companies they will recover after the economic downturn. For example, the consumer industry, the semi-technology industry, and the property industry, the banking industry. But for some companies with high gearing, once they are hit by the economy downturn, yes, they might grow very, very well before the economy downturn, but they're geared up so bad in the event of a high rising interest rate, they are hit by the escalated interest rate. So their costs are higher. They are forced to, going into default. So these kind of companies that you should avoid at all costs, no matter whether it's a good or bad economy. High gearing company, try to avoid unless you really understand the business well and you know that their cash flow is sufficient to clear off the debt in their upcoming times. And even if you identify a good company, so the market keeps dropping. So how do you avoid catching the knife? So let's say if you're buying today, tomorrow the share price drop by 20-30%. So what should you do? To me, I will practice this year. I still practice it now. Every month, if I have the capital itself, I would continuously invest in a company. So think of this: if you were willing to invest in a company at a 20-30% price higher, that is where before you buy, and the share price 20 or 30% higher. So why you wouldn't be happy to buy at another 20-30% discount, right? That means that you don't understand the business well enough, or you made a mistake somewhere that you do not know, right? So you have to reassess the whole thing, whether it makes sense to invest the money in or not. Or you should separate your investment. Let's say you have a 5,000 or 10,000, you should separate into 2 or 3 portions before you invest into it. That's also something I practice, especially on some of the relatively higher risk investments. But for more stable stocks like REITs, when I'm accumulating them, then I will do this year, right? I think, okay, maybe one more question. Okay, there's a different in terms of front end and back end. I think I have covered the front end and back end, which again, for the benefit of those who just joined in, front end is basically the companies who are involved in dealing with the wafer. That means that if you can Google wafer, it's basically a piece of silicon. And then back end, they are more towards assembly, testing, handling. So basically, it's what we see, the chip part. Okay, so at the front end part, it's more technical. Imagine they have to draw the circuit onto the wafer itself, and a lot of sophisticated equipment are required. For example, the SML itself, right? So naturally, the margin over this part is higher. And then for the back end, tester, handler, there are a lot of companies that actually does that, especially in Penang, Malaysia. But again, what is the unique part of your product as compared to when we are comparing to bigger companies like companies in US, companies in China is catching up, and then companies in the Euro market, they are more sophisticated when we talk about back end. So what is the age of the company itself, right? And maybe this question that's coming in the Q&A. So views on Singapore market liquidity. I think if you're talking about 1 year back then, probably it's not so well, but sorry. Now probably it's doing much better. As I shared just now, their average daily traded value increased by 14% on month-on-month basis. It's slowly getting better, but if you compare to more liquid market like US or maybe Hang Seng or maybe Malaysia, obviously that's Malaysia is actually subjective. our smaller cap are usually the top traded volume on daily basis. But in terms of market liquidity in Singapore, as a retail investor, I think it's still sufficient for us to, go in and exit as long as your, I don't think our capital is so sufficient enough to buy off a few ticks for now, right? At least not for me. So I think has been improving. But if you want to talk about the actively trading and also the holistic liquidity, I think US is still more active in that sense, right? I think that's all the time I have. I'm happy. By the way, I'm happy to answer the rest of the questions. If you guys could just drop me a message on my Facebook, Want to Invest. So all the questions, I hopefully can answer them, right? Just drop me a message on your question. I will answer them afterwards. But now I think I'll pass the stage back to the host.
Thank you, Max, for the in-depth sharing. And to all our viewers, thank you for tuning into the session. And I believe most of the questions has been answered. If not answered, it's due to time constraint as well. So you can send the questions to back end if you really want your questions to be answered. So if you're interested to know more about trading in the Singapore market, you can visit the link or QR code shown on the screen, and then you can have more information from there. To have more in-depth information or daily updates on Singapore market, you can even join the SGX Invest Telegram channel, which is shown on the screen. You can scan the QR code or visit the link as well. What is the brokerage rate? Just one quick question that I saw. Brokerage rate depends on which selected advertiser that you have account with. So you can find out more with them. If you have interest in opening a trading account for investing in Singapore, you can send us your contact details on the chat box privately, or you can scan the QR code here to send in your contact details as well. Then the respective team will be able to answer your questions on brokerage rate, on trading account related questions. Okay, so I just want to highlight also that for today, if you open a trading account with the selected advertisers shown on the screen, you will get an extra 500 MQ points. So remember to sign up now if you're interested. For all MQ members, you can also get a bonus of 300 MQ points as check-in rewards. You just need to submit a screenshot of any part of this webinar to the post-webinar quiz that will be sent to your email shortly after this webinar ends. So if you haven't registered, remember to register as well. You can use the QR code here on the screen to register for this webinar so that you can get the post-webinar updates, including the quiz and also the recordings. Right. So once again, thank you very much, Max, for your sharing and also answering all the questions. We will be starting our mysterious gift session very soon. So get ready on your keyboard. Normally, people will be very active during this session. You can get to win gifts worth up to 249 ringgit. So how it works is I will show questions on the screen, and then there will be options for you to answer A to A, B, C, D, and then the first two person who answer for each question will be the winner. Answer correctly. So the first two person who answer correctly will be the winner. There will be three questions, total 6 winners altogether. Okay, so if you are ready, I will start very soon. Right, so the first question, what is one of the strategy to navigate in the Singapore market for stability? A, B, C, or D? Focusing on solely one single stock or buying stocks that is favorable to most investors, C or D? I see a lot of questions coming up, answers coming up already. Okay, so let me announce the answer is D. So it is to diversify your portfolio by gaining most exposure to different currencies or different market as well. So let us see who is the first two winners. Chu and LT Yo. You can use use the link shown on the screen or in the chat box to send us your contact details so that we can arrange the gifts. So get ready. We have 2 more questions. Yeah, there are links here already, Jeff Tan. So there are links on the chat box for you to fill in, for winners to fill in. So the winners would be Chiu and LT Yo. Right, get ready. Second questions. Ideally, should you focus on dividend-based stocks or growth stocks, or both? A, B, C, or D? I think the obvious answer to avoid is B, because it's not in the question itself. Okay, so I see a lot of answers already. So the answer is A, both dividend and also stocks. Both dividend stocks and also growth stocks. Like what we have mentioned on the first question is to diversify. So you will need to diversify in between different type of stocks as well. So the winner for this question is Tay888 and Ho. Remember to use the Google link form in the chat box or on the screen to send us your contact details for gifts arrangement. Next, last question, get ready. How many stocks are there in the STI index, Straits Time Index? It is the blue chip index thing in Singapore. Remember to answer A, B, C, or D. I see some people type out the numbers, but yeah, we need A, B, C, or D. Yeah? So the answer is C. You type it correctly, which is 30. And the first 2 winners, let me check. It will be Yuk Long Liu and ERBC. So you can use the Google form, the link on the screen or on the chat box to send us your contact details. For those who didn't manage to win, it's okay. You still get your bonus 300 MQ points as check-in rewards. So remember to submit your screenshot in the post-webinar quiz for MQ Trader members. And if you want the quiz to be sent to your email, remember to register for the webinar as well. For non-MQ members, you can also sign up with our for a trading account with our selected advertiser to get a bonus 500 MQ points. So remember to do so if you're interested to get your gifts for this webinar as well. Lastly, just want to mention we have various social media platforms. We are on various social media platforms as well, including Facebook, Instagram, iTree Investor, YouTube, TikTok, and even MQ Chat. So if you want to know more or get our daily market updates, remember to follow us on our social media so that you can get our daily market updates and also even campaigns update as well. Once again, a very big thank you to all of you who have participated in this webinar. You have made it a success for this. And thank you for staying true. I hope you have learned something today. I will turn off my camera now. The webinar will be live for a few more minutes for our winners to submit their contact details. And also for those who want to refer to the links in the chat box, you can also still refer to it. Once again, thank you for participating in our webinar today. I'm Casey from MQ Trader and I wish you a great week ahead. ERBC, sure, no problem. Let me just send the link again. Only winners will be contacted or will be sent, the gifts will only be sent to the winners mentioned. Okay. So thank you everyone. Good night.
Thanks for watching.